Nvidia reported $81.6 billion in quarterly revenue, a number that, on its face, should have sent its stock through the ceiling. Instead, shares whipsawed after hours, touching a high, then pulling back, because the figure Wall Street chose to focus on was not the revenue beat, but the forward guidance gap. Jensen Huang has publicly projected a path to $1 trillion in data center revenue through 2027, anchored in Blackwell and Vera Rubin chip cycles. But the Q1 report did not show the sequential acceleration that would make that trajectory feel inevitable. What the report did confirm is that roughly 60% of Nvidia's data center billings flow to 4 hyperscalers: Amazon, Google, Meta, and Microsoft, which means Nvidia's revenue line is functionally a proxy for hyperscaler capex decisions, not broad enterprise adoption. That concentration is a frame issue, not a growth issue, and the market priced it as such. Interpreted from price and volume action alone, institutional holders rotated within the semiconductor complex rather than reducing exposure. AMD surged 8.1%, Astera Labs jumped 17.7%, and SMCI gained 9.5%, suggesting passive and active funds rebalance toward names with lower valuation premiums while keeping sector allocation intact. The Nvidia premium is the question the rotation leaves open. If hyperscaler capex moderates in Q2, the 60% concentration becomes a ceiling, not a floor.
That same concentration risk Nvidia investors are discounting has now been repriced explicitly in the SpaceX IPO filing, and the number that changes the picture is not the $1.75 trillion valuation target. It is the $6.355 billion operating loss posted by the XAI segment in 2025 alone. SpaceX's legacy Starlink and launch businesses are profitable. The loss is entirely AI-driven, which means the filing is asking public market investors to extend the same valuation logic that private AI funding rounds have used, revenue potential over current earnings, to a company now required to file quarterly. The mechanism deepening here from the Nvidia chapter is direct. Nvidia's $81.6 billion quarterly revenue is the proof of concept that AI infrastructure can scale into profit. SpaceX's XAI segment is asking investors to believe the same transition is coming, but from a $6.3 billion annual loss base. From price action, retail and early institutional demand rotated into space-adjacent names. Rocket Lab gained 5.5% on the filing day, while the Nasdaq IPO pipeline absorbed the signal as positive risk appetite for AI-heavy offerings, including the OpenAI flotation now reportedly targeted as early as this week. The condition that determines whether SpaceX's AI premium holds after listing is whether XAI's $818 million Q1 revenue can outgrow its $2.5 billion quarterly operating loss before the first lockup expiration forces Musk's 85.1% voting bloc into scrutiny. The Starlink segment's 49.8% year-over-year revenue growth provides the profit bridge, but the bridge has a width, and XAI is burning $2.5 billion a quarter against it.
The condition that would let SpaceX's AI premium expand, a return to rate cut expectations, was closed by the Fed April minutes released the same day. 4 FOMC dissents, the most since 1992, voted against maintaining an easing bias, and the minutes explicitly state that a majority of participants believe some policy firming would likely become appropriate if inflation remains above 2%. Dallas Fed President Lori Logan named the Iran war rate as a source of prolonged or repeated supply disruptions that could sustain inflationary pressure, which connects the geopolitical relief trade in oil directly back to the rate calculus. The Iran peace signal pushed oil down sharply Wednesday, and that drop briefly reduced rate hike odds, which is why equities rallied broadly. But the Fed minutes signal that the relief is conditional on the Strait of Hormuz reopening durably, not just on a ceasefire that has been in place since April 8th without restoring shipping. If Hormuz remains partially closed, food and energy price pressure persists, and the Fed's next move at the June 16th-17th meeting, Kevin Warsh's first as chair, is more likely a hold with hawkish language than a pivot. Rate-sensitive technology holders who bought the Iran relief trade Wednesday are carrying duration risk that the Fed minutes did not reduce. The benchmark to watch is the 30-year Treasury yield, which would need to fall below 5.0% to signal that the bond market has absorbed the Fed's hawkish shift. The Iran ceasefire held for 6 weeks without reopening the strait. That is the fact that the oil relief trade has not yet priced. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.